When you think of luxury cars, BMW and Porsche are probably the first names that come to mind, synonymous with style, performance, and a certain unmistakable prestige. These brands have long been the dream of car enthusiasts and a status symbol for those who appreciate the finer things in life. From the roar of a Porsche engine to the sleek lines of a BMW, they represent more than just vehicles. They're icons of aspiration and achievement. Their emblems are instantly recognizable, standing as symbols of success and German engineering at its finest. For many, owning one of these cars is a lifelong goal, a reward for hard work and ambition. For decades, these brands have set the standard for premium cars, earning global respect and a loyal following. Their vehicles are celebrated for their innovation, reliability, and the sheer joy they bring to drivers around the world. Whether on the Autobahn or city streets, BMW and Porsche have been at the forefront of automotive excellence, shaping the industry and inspiring competitors. But today, things are changing fast. The automotive landscape is shifting in ways that even these giants couldn't have fully anticipated. A storm is brewing, and it's not just about the weather, it's about the future of the entire industry. On January 9, 2026, Barclays, a major global bank, issued a stark warning about the future of both BMW and Porsche. This wasn't just a routine financial update, it was a wake-up call that caught the attention of investors, car lovers, and industry insiders alike. This isn't just a minor hiccup. Barclays is worried about serious challenges piling up for these legendary automakers. The concerns go beyond short-term setbacks. They point to deeper, more structural issues that could threaten the very foundations of these companies. The news has sent shockwaves through the car industry and financial markets. Investors are anxious, analysts are scrambling to make sense of the situation, and the world is watching closely to see how these icons will respond. So, what's going on? Why are these titans suddenly in trouble? Customers are starting to ask questions, and even the most loyal fans are feeling uneasy about what lies ahead. The answer involves fierce new competition from unexpected places, political hurdles that are reshaping the rules of the game, and a massive shift in their most important market, one that could redefine what it means to be a luxury automaker in the 21st century. Let's break down what's threatening the German giants and why it matters to all of us. Because the fate of BMW and Porsche isn't just about cars, it's about innovation, jobs, and the future of an industry that touches millions of lives around the globe. So what does it mean when Barclays downgrades BMW and Porsche? Think of it like a movie critic dropping a 5-star director to 3 stars. In finance, a downgrade means the bank is less confident about a company's future profits. Barclays changed its rating for both companies from equal weight to underweight, a clear warning that they expect these stocks to underperform. This isn't just a hunch, it's based on deep research into sales, costs, and market trends. The main concerns? Declining profits, tough new competition, and rising costs. When a big bank like Barclays issues a downgrade, investors pay attention. Stock prices can drop fast. Barclays even set lower price targets for both companies, predicting their value could fall by up to 15%. That's why this downgrade is making headlines. One of the biggest reasons for concern in the global automotive industry right now is China. For years, this vast and rapidly developing country has been the single most important market for luxury car makers, driving their growth and shaping their strategies. The sheer size of the Chinese market, combined with a growing middle class and a taste for premium brands, made it a goldmine for companies like BMW and Porsche. These German automakers have relied heavily on China as the engine of their global expansion, pouring resources into showrooms, marketing, and local partnerships. For BMW and Porsche, China wasn't just another market, it was the market, the place where their ambitions for global dominance could be realized. In fact, China accounts for about a third of BMW's total sales worldwide, and a huge chunk of its profits. For Porsche, the numbers are similarly impressive, with Chinese customers snapping up their luxury vehicles in record numbers, at least until recently. But the landscape is shifting fast. Chinese buyers, especially the younger generation, are now flocking to homegrown brands that are producing cutting-edge electric vehicles. These local companies are not only offering advanced technology and innovative features, but they're also tapping into a sense of national pride and identity. The impact has been dramatic. Between 2021 and 2025, BMW's sales in China dropped by nearly 300,000 cars, a staggering decline that would have been unthinkable just a few years ago. Porsche too has felt the pain, losing over 50,000 sales in the same period. Showrooms that were once bustling with eager buyers are now noticeably quieter, and inventories are piling up. The loyalty that once fueled German brands is fading fast. Chinese consumers are increasingly choosing local electric vehicles, drawn by their affordability, advanced features, and the excitement of supporting domestic innovation. This shift is a massive problem for BMW and Porsche, who invested billions of dollars in the expectation of endless growth in China. Their factories, supply chains, and marketing strategies were all built around the idea that Chinese demand would keep rising. Now, financial analysts at Barclays and other institutions are warning of a long-term, structural problem for German automakers in China. The old playbook no longer works, and the competition is fiercer than ever. When your biggest market suddenly turns into your biggest challenge, the road ahead gets rough. And for BMW and Porsche, navigating this new reality in China will require bold moves and a willingness to adapt like never before. So, who's winning in China? Meet the new stars: Li Auto, Xiaomi, Aido, and Zeekr. These brands are exploding in popularity, growing sales by hundreds of thousands of cars in just a few years. Their secret? Cutting-edge electric vehicles packed with tech. Think giant touchscreens, karaoke machines, and constant software updates. They're building cars that feel more like smartphones on wheels, perfectly tuned to what Chinese consumers want. As a result, German brands suddenly look old-fashioned to a new generation. And it's not just China. These companies are now exporting to Europe, grabbing market share fast. Chinese brands' share in Europe doubled to 7% by the end of 2025, putting even more pressure on BMW and Porsche. The competition that started in China is now a global battle. As if new rivals weren't enough, BMW and Porsche face another big problem: US tariffs. Tariffs are taxes on imported goods, making it more expensive to sell European cars in America. Automakers must choose: absorb the cost and lose profit, or raise prices and risk losing customers. Barclays estimates these tariffs could cut profit margins by about 1.5%, which adds up to hundreds of millions in lost profit. This is a major reason Barclays doubts Porsche can hit its profit goals before 2028. Tariffs are a political problem automakers can't control, but they hit the bottom line hard. It's another powerful headwind for the German giants. In today's world, business and politics are more connected than ever. BMW and Porsche aren't alone. Almost every traditional car company is feeling the heat. The whole industry is being shaken up by Chinese competition, the high cost of going electric, and global tariffs. Barclays' report shows some companies are adapting better than others. Mercedes-Benz, for example, avoided a downgrade but still faces big challenges. Volkswagen, on the other hand, is Barclays' top pick, thanks to strong finances and smart strategy. Ferrari stands out too, protected by its ultra-luxury niche. The lesson? Famous brands can't coast on history. They need to be agile, invest in new tech, and manage costs carefully. The companies that adapt will survive. Those that don't will struggle. The old order is breaking down, and the winners are being reshuffled. So, what does all this mean for us? For car buyers, it's good news. More choices, better tech, and maybe even better deals as companies fight for your business. For investors, it's a wake-up call. Even the strongest brands can stumble, and staying informed is crucial. Downgrades like this can shake up portfolios and highlight new opportunities, maybe even from companies you've never heard of. For workers, the shift is huge. As old automakers struggle, new EV companies are creating jobs in software, batteries, and tech. The skills needed in the car industry are changing fast. This shakeup affects everyone, from buyers to investors to employees. The next few years will be full of change and opportunity. The car world is being reinvented before our eyes. Is this the end for BMW and Porsche? It's a question that's on the minds of car enthusiasts, industry insiders, and investors alike. The automotive world is undergoing a seismic shift, and even the most iconic brands are not immune to the pressures of change. Not at all, but the challenge is real. The landscape is evolving at a pace we've never seen before, with new technologies, regulations, and competitors emerging from every corner of the globe. For BMW and Porsche, the stakes have never been higher. These companies have survived tough times before, weathering wars, economic crises, and technological revolutions. But today, the speed of innovation and the scale of disruption are unprecedented. To stay ahead, they must adapt faster than ever, rethinking everything from their supply chains to their core business models. They're investing billions in electric vehicles and software, betting big on a future where cars are clean, connected, and increasingly autonomous. But this transition is both expensive and risky, requiring not just money, but a willingness to embrace uncertainty and reinvent themselves from the ground up. BMW's Neue Klasse platform is a bold move, representing a complete reimagining of what a BMW can be. It's a massive investment in new technology, design, and manufacturing, and while the payoff could be huge, it will take years and significant resources to see results. In this new era, partnerships and collaborations are no longer optional, they're essential. By joining forces, companies can share costs, pool expertise, and accelerate innovation, giving themselves a fighting chance in a market that's more competitive than ever. Meanwhile, Chinese brands are rapidly expanding into Europe and other global markets, bringing fresh competition and sparking political debates over trade, tariffs, and the future of the industry. Their aggressive push is forcing established players to rethink their strategies and defend their turf. The next decade will be a fierce competition, a race for survival and dominance. Some familiar names may not make it, while new leaders could emerge from unexpected places. The only certainty is that the industry will look very different 10 years from now. The very definition of a car is changing. It's no longer just about horsepower or luxury. It's about software, connectivity, and the seamless integration of digital experiences with physical engineering. The car of tomorrow will be as much a computer on wheels as a machine for driving. The winners in this new era will be those who can master both worlds, the art of building great cars and the science of creating cutting-edge software. For BMW, Porsche, and their rivals, the journey is just beginning, and the road ahead will be anything but predictable. The Barclays downgrade is more than a financial story. It's a sign of a new era in the auto industry. The old race was about horsepower and luxury. The new race is about batteries, software, and digital experiences. Chinese EV makers are rising fast, unburdened by legacy factories or old technology. BMW and Porsche now have to prove they can innovate in this new world. The competition will be tough, but it will lead to better, cleaner, and more exciting cars for everyone. The old kings have been challenged, and their response will shape the future. A new race is on, and the finish line is wide open. Buckle up. It's going to be one heck of a ride.